The Bogleheads Guide to Investing. Choose a sound financial lifestyle. Take 100 Americans starting out at age 25. By age 65, 1 will be rich and 4 will be financially independent. The remaining 95 will be unable to fund themselves in retirement. Which path will you choose? Become a keeper, not a borrower or consumer. The keepers invest their money and pay themselves first. They follow a sound financial plan and invest for their future. Take these 3 steps before you start investing. Number 1, switch from a paycheck mentality to a net worth mentality. Stop thinking about your salary. It's not how much you make, it's how much you keep that's important. Focus on building your wealth over time. Number 2, pay off credit card and high interest debts. And number 3, establish an emergency fund. 3 to 6 months should be suitable for most people. Investing. Start investing early and invest regularly. The magic is in the compounding. Most people earning a modest salary think that the only chance they have of becoming a millionaire is to win big on the lottery. However, if a 25-year-old on $25,000 a year deposited around $4,000 a year into a retirement account, and then that grows at 8% per year on average, they will be a millionaire by age 65. If that same person waits until 35 to start investing the $4,000 per year, the pot will only be worth around $490,000. Pay yourself first and start as early as possible to make the most use of compound interest. Keep investing simple. Investing is different from other areas of life. Often we hear things like, don't settle for average, strive to be the best, or you get what you pay for, cheap isn't good. If there's a crisis, then take action and do something to fix it. However, applying principles like this to investing are destined to leave you poorer. Index investing. It pays to be lazy. This is a strategy that takes very little investment knowledge, no skill, and hardly any time or effort, but outperforms about 80% of all investors. It allows you to spend your time focusing on other things in life, whilst your nest egg compounds on autopilot. The fluctuations of the stock market cause investors to focus on short-term volatile movements and expectations of the market, rather than the more important long-term gradual accumulation of the returns earned by the great businesses of the world. Rather than focusing on these short-term movements and individual companies, we should simply buy a portfolio of shares of every business in the market and hold it forever, so that we can benefit from the returns that corporations generate through their dividends and earnings growth. Where there are multiple solutions to solve a problem, it usually is the best approach to choose the simplest one. Therefore, the simplest approach to investing is to hold a broad-based, low-cost stock market index fund which seeks to replicate an index, such as the S&P 500 for example, minus a very small management fee. Why indexing is so effective? The main reason for this is rock-bottom costs. We don't know what future returns will be, but we do know that an investor that keeps their costs low will earn a higher return. Investing is a zero-sum game. Investors as a group must earn the precise market return before costs of investing are deducted. When the fees associated with active fund managers and trading fees etc. are deducted, it means majority of investors' returns will fall below the average market returns. Index funds are also extremely simple, tax efficient, come with higher diversification and less risk, and no need to worry about the poor performance of a fund manager. Asset allocation, the cornerstone to successful investing. This will be the most important portfolio decision you make. Asset allocation is the process of dividing our investments into different kinds of asset classes to minimize our risk and maximize our return. We do this by asking ourselves what investments should we select and what percentage should we allocate to each. Some portfolio guidelines from the Bogleheads are as follows. A young investor's asset allocation might look something like the following: 55% domestic large cap stocks, 25% domestic mid cap small cap stocks, and 20% bonds. A middle-aged investor's allocation might be 30% large cap domestic stocks, 15% small and mid cap stocks, 10% international stocks, 5% in REITs, 20% in diversified bonds, and the remaining 20% in inflation-protected securities. An investor in early retirement might allocate 30% to domestic stocks, 10% to international stocks, 30% to intermediate-term bonds, and 30% to inflation-protected securities. The main thing that changes is the gradual dialing down of exposure to equities and resultant increase in lower risk assets, such as intermediate-term bonds, and inflation-protected securities. Track your progress and rebalance when necessary. Rebalancing is the process of bringing the portfolio back to its intended asset allocation. Rebalancing controls risk and forces you to sell a good performing asset to purchase a poor performing asset. This results in the process of selling high and buying low. Set up a plan of how and when you'll check your portfolio and rebalance in line with this plan. For example, rebalance if the asset allocation moves more than 5% from the original allocation, or rebalance once per year are common strategies. Simply choose which strategy works for you and stick to it through thick and thin. Tune out the noise. All forecasting in investment media is almost always wrong and is designed to heighten your emotions, which can lead to bad investment decisions. Mastering your investments means mastering your emotions. In the world of investing, greed and fear can destroy your returns. Thanks to greed, investors excitedly chase performance and buy when the market is up. And thanks to fear, they panic and sell when the market is down and lock in those losses. It's hard to make a profit when you buy high and sell low. Keep your ego in check. Despite the statistical impossibility, most people believe that they are above average drivers, above average in appearance, and have above average intelligence and so on. If this translates into your investment decisions, your ego and overconfidence will betray you. If you think you can pick stocks, time the market, or know more about what's going on in the economy than others do, then you are a prime candidate for letting overconfidence ruin your finances. The stock market is a very expensive place to learn that neither you nor anyone else is endowed with the gift of investment prophecy. Loss aversion. This is the opposite of overconfidence. Not investing in the stock market and keeping your money in the bank means that you are almost guaranteed to lose to inflation over the long term. There is no way to completely avoid risk in life. Herd mentality. Humans have an innate need to conform and follow the crowd, but in investing, you will follow the herd to the slaughterhouse. Herd investors don't have a sound investment plan. They listen to and act on noise, buy and sell at the wrong times, and have no idea how badly they are performing in relation to the market. Don't be that person. Make sure you establish a sensible, well-designed investment plan, keep your emotions in check, and stay the course.